Welcome everyone. I'm sorry for our slightly late start. Some of the participants, there was a fire alarm. Good afternoon. Welcome to the Financial Inclusion Forum event on the investor responses to COVID. And thank you also for people making time today. I know a lot of people are glued to the cricket, so I appreciate you tearing away from that. I'm Paul Blythe, the chair of the Financial Inclusion Forum. And we have many old friends joining us today, but there's also a few folks who are attending for the first time. So I'm going to say a little bit about the Financial Inclusion Forum. We exist to raise awareness of financial inclusion and share best practice. This encompasses everything from economic empowerment to microfinance and impact investment. We do this by holding Chatham House Rules breakfast events for industry practitioners and online and evening events for experts and the general public alike. We also record our events and share these and other examples of best practice on our social media platforms, our website, and our blog. These are excellent resources for professionals, students, and anyone interested in financial inclusion. The UK played a leading role in the 2005 UN Year of Microcredit, and we were born out of that as the Microfinance Club. We're now entering our 16th year as the Financial Inclusion Forum. We've been focused primarily on developing world financial inclusion over the years, but as a UK-based organisation, we also have a specific programme related to what UK financial inclusion can learn from the rest of the world. Our recent event on digital ID is an example of our work in this area. We are a completely volunteer board, and all of our events are free. We are supported by a part-time professional secretariat, and so this event would not be possible without the support of our corporate and individual sponsors. So I'd like to formally thank City Inclusive Finance, CDC, EY, and Vision Fund as core sponsors. So please support our work, either in a personal capacity or as a corporate sponsor. If your organisation has an interest in aligning its brand with economic empowerment, financial inclusion, impact investment and the like, in the UK and or around the world, then please get in touch with us at admin@financialinclusionforum.org.uk as an individual sponsor using the QR code, which is hopefully on your screen, or via our website, financialinclusionforum.org.uk. Today's event, what a cracker. My day job is as an impact investor, and I'm often asked, what's the difference between an impact investor and a regular investor? And I think the COVID crisis has brought this to the fore. Impact investors often respond very differently to traditional investors. I recall the Nicaraguan crisis in microfinance many years ago, and how many impact investors came together then to support borrowers and institutions and get through that. And COVID is that on a much bigger scale. And I very much look forward to the event. And I will now pass to my colleague and fellow board member, Kate, and thank all the panelists in advance for their contribution. Kate, over to you.
Thanks, Paul. So hello all, and thanks again for joining us for today's webinar. So I'm Kate Hallam. I'm one of the board members of the Financial Inclusion Forum, as well as an investment director in CDC's Financial Services Equity team here in London. So for those of you who don't know us, CDC is the UK's development finance institution. We're wholly owned by the UK government with over 70 years experience of successfully supporting the sustainable long-term growth of businesses in Africa and South Asia by investing patient, flexible capital. Currently, CDC has over 1,200 investments, and around a quarter of our $6 billion portfolio is actually in financial services. And CDC's response to the pandemic has had three key pillars, which are outlined here, some examples of which we'll be covering in more detail later in the webinar today. Whilst we also adapted to incorporate more flexible process changes such as express ICs and remote due diligence. So preserve was our first pillar, and this is our first priority in supporting our current investees, whether it's through providing emergency finance or advice. Strengthen, we also looked at how we can extend our support, whether that was working with local banks to provide the working capital that businesses so badly needed, or exploring investments that scaled up access to healthcare and basic services. And then rebuild. So obviously the crisis isn't over yet in many of our markets, and its effects will be felt long after in the countries where we invest. Financial institutions like CDC will be critical to the rebuilding process. So before we jump into the webinar and with the panelists, I just wanted to give you a few points on logistics. So attendees will be muted to ensure panelists aren't disrupted. So please rely on the Zoom chat function for any questions as you go through. Ideally, if you could add your name and location, that would be great. And we'll aim to answer as many of these as we can at the end. And just noting, the recording will also put on FIF's YouTube channel if you have to miss any part of it, or pass on to your friends. So why are we hosting this webinar? So before we begin this, so the impact of the crisis on financial institutions has tended to be highly correlated to the macroeconomy of the countries that they operate in, many of which in emerging markets are in recession stemming from COVID-19. Furthermore, the crisis has challenged their clients' business continuity, disrupted livelihoods, and impacted access to financial services, which has affected demand and portfolio quality. Pressure on liquidity and solvency has meant that investor support was needed not only to mitigate the worst effects of COVID-19, but also to enable financial institutions and their clients to adapt and build resilience against future shocks. However, due to the increased risk, foreign direct investment globally has declined, almost half the amount in the first half of 2020 versus 2019. And there's been capital flight, particularly from emerging markets. So how did some investors, such as DFIs and Impact Funds, step up to adapt and provide this critical support? This webinar will highlight some of these responses across technical assistance, funding, advocacy, and help draw conclusions around best practice in crisis situations for the future. So we've got a packed agenda for the next hour and 20 minutes or so. We'll be hearing insights from some esteemed individuals, as outlined here on the agenda, ranging from, as I said, technical assistance to systemic liquidity, supporting the microfinance sector, debt handshake agreements, and finally launching an MSME support fund. So without further ado, I'll hand over to our first set of panelists. We have Alex Kachowski and Fanny Sayre from CDC Group and Advanced Microfinance Network, who will be talking about CDC's technical assistance response. Alex is an executive at CDC Plus, the technical assistance facility of CDC. He's the lead for TA in the financial sector, as well as on upstream activities in frontier markets. And prior to CDC, Alex worked on a number of private sector development programs in West Africa. Fanny is the group head of marketing at Advance, a leading microfinance player operating in 9 countries across Africa and Asia. Fanny supports Advance teams on being customer-centric and delivering impactful experience across all products, services, and touchpoints. She also oversees social and environmental performance. And prior to Advance, Fanny started her career in the field of responsible investment. So over to you, Alex and Fanny.
Great, thank you very much, Kate. So I'll start with a little introduction about CDC Plus and about our response to the COVID pandemic, and then hand over to Fanny, who will talk a little about the results of the project that we did with Advance. So CDC Plus, as Kate mentioned, is CDC's technical assistance facility. It's funded by the UK government, and the aim of it is to support driving the impact of our investees, but also supporting the impact at the market level. So in April 2020, at the start of the pandemic, we set up a kind of rapid response to support our investees, and created facilities to both help investees weather the crisis and preserve the impact, but also help investees pilot new business models and new business processes that can help serve underserved groups during this difficult time. The facilities supported over 67 projects with a value of around $7 million, with the aim of reaching and positively impacting over 4 million people in Africa and South Asia. One of these projects that we wanted to highlight today is the one we did with Advance. So Kate, if you wouldn't mind moving to the next slide. Advance is a microfinance network, and CDC is an equity investor in the network. Advance approached us to get some support in responding to the pandemic. And our support focused on 4 things. One is to support Advance in better understanding their customer needs, both women and men, and how those needs have changed as a result of the pandemic in the countries of operation. It also centered around adapting products and services offered to meet those needs, and training staff to be able to better respond to those changed needs. We also supported Advance in taking an increased gender lens during this time and looking at their kind of processes and systems with a kind of gender lens. So I'll hand over to Fanny to discuss how that project went and what the results were.
Thanks, Alex, and good afternoon, everyone. So as Kate and Alex just mentioned, so Advance had to answer and reply very quickly to that crisis that with this first wave, which actually burst at the same time in our 9 countries of operations. So what we had to do is to respond very quickly with agility, and to make sure that we could keep a balance between an industrialized response, I would say, thanks to the digital platform that CDC helped us to deploy very quickly. And that would enable us, and that had enabled us to deploy some very tailor-made and micro solutions for each and every clients and borrowers that were hit by the crisis very drastically. So that is what we've done. We've actually been able, thanks to the support from CDC, to deploy this digital platform that helped us to get in touch with 400,000 clients and to offer them a tailored solution. What was very important for us at that point was, first of all, to assess the impact of the crisis on our clients, to limit the risk of over-indebtedness and difficult situation and the increase of portfolio at risk. It was also to reassure our clients that in the middle of this crisis, Advance were there for them, and getting in touch with them very quickly to assess their situation and reassure them that we were staying and we were supporting them all through this crisis, to get through this crisis. It also enabled us to limit any withdrawal or any impact on our deposit portfolio. I would say that it was quite amazing to see all the staff, all the teams that we have in our countries of operation being able to get in touch with these customers and being able to get and keep this right balance between managing the crisis very quickly, and again with solutions that we would deploy with agility, given the situation that we were assessing for each and every client that were facing difficulty. In parallel, and because this crisis is actually not over, we deployed an external survey with an external partner that was also supported by FMO. So we deployed a survey with 60 decibel that helped us to better understand the broader impact of the crisis on our clients and our family. And this is still helping us to better understand how we can adapt longer term our approach for supporting clients. Because actually the first wave was very difficult to handle, and we did it well, but the long-lasting impact are still and remains important in all of our countries of operations, with a variety of situations that are still evolving on a day-to-day basis. So it's very important for us to keep an eye on what is happening on the ground and in the field, so that we can be prepared and react as quickly as we did in March, April and May if something is happening again. I would just give you a quick overview also on something that we did in Tunisia, that we piloted in Tunisia, which was a more specific support for the most vulnerable entrepreneurs that we assessed as being vulnerable, thanks to the digital platform and the contact points that we deployed with our customers. And we did actually support women more specifically, because as I'm sure most of you have observed, women were very much impacted by this crisis and are still impacted. So we actually wanted to support them more specifically, which led to another thought and discussion, set of discussions with CDC, helping us now to better understand longer impact on women, and how do we prepare for answering their needs and their specific needs as entrepreneurs in some of our countries of operations. So just as in a nutshell, I would say that what CDC helped us to deploy to manage that crisis was being agile, making sure that we can keep this balance between a global and standardized way of managing the crisis as a group, but also making sure that we could keep and stay in touch locally with each and every customer who might face difficulty. And that was definitely what Advance's objective was, to be and to react with an impact-driven and result-driven mindset that we managed to keep all along the crisis, and we still have today. Kate, if you want to move to the next slide, please. Thank you. So as I said, and this is also quite a few key success factors I wanted to highlight in the way we've actually managed the crisis at Advance. For me, there are three level of actions that we were able to deploy. As I said, the micro level, so making sure we could keep an eye and stay in touch with our customers and specifically borrowers that might face difficulty at the moment of the first wave, but also in the long run. Second level is a country approach, because in that kind of crisis, it's very important that we have and we set up industry response so that microfinance institutions all together can raise their voice when it comes to decisions that central banks and regulators are making. And that is something that we've done and we've reinforced during that crisis. And I think it's really a key success factor in managing that locally. And then I would say the third level is the group level, or the international level, and the fact that Advance is a group that is supported by strong partners really helped us to be super reactive. And it was very important that at a group level, we kept in touch as well with our key partners. We could reassure them on the way we were managing the crisis, but also we could give them opportunities to support us to deploy our solution. And just as a word for ending my presentation, I would also say that, as I mentioned earlier, this crisis is not over, and we can still see a pocket of vulnerabilities in some of our countries or some of our segments of customers. And for us, it's very important that we keep managing that crisis in the long term. And it's definitely something that we are doing and we will keep doing, so that we can adapt again what we should be deploying as solutions in the future. Alex, I'm ending over to you.
So I think there's a couple of lessons I'd just add from a kind of DFI and impact investor perspective. I think one of them was that we really had to speed up our response and shorten processes, look at our application forms, contracting, to really be responsive and flexible to the needs of our investees. And the second point, which Fanny briefly mentioned, which is that rather than supporting kind of short-term activities, we felt that investing in kind of resilient processes and systems within the financial institution that are responsive, that can help understand customer needs, can help deliver on those adapted needs, that sort of investment paid off, given the kind of long-term nature of this crisis. And it can also position Advance, but also other investees well to deal with other crises like political instability or natural disasters. I think investing in those systems can create more resilience in the financial institution.
Great, thanks both. It's really good to hear of the client-centric and, as you said, resilient response that was taken. Okay, so going from micro now to the large end, we've got Freddie Tucker, who's going to be talking around systemic liquidity as part of CDC's response. And Freddie is an investment manager and focuses on trade and supply chain finance for CDC. He previously led an award-winning SME supply chain finance transaction using UK export finance, and has spent over 8 years providing export trade and supply chain finance in Africa. So Freddie, over to you.
Great, thanks very much, Kate. And good afternoon, everyone on the call. As Kate mentioned, I'm part of CDC's Trade and Supply Chain team. We have a book of commitments of roughly $1.5 billion across Africa and South Asia. The majority of those commitments are through master risk participation agreements. And this slide sort of gives a quick introduction to how those work and to try and show how they set out to provide systematic liquidity to the markets that we operate in. So CDC partners with global and regional banks. You'll see a list of our partner banks there. And we partner with those banks to provide risk mitigation, to provide guarantees, to provide funding to the local issuing banks across our markets. We partner with the larger banks because this enables us to scale. And they in turn then provide financing down to the local issuing banks, who in turn are on the ground and providing finance to local corporates, SME importers. As CDC, we actually track where our money goes right through this system. So we can see at the local corporate and SME importer level, transaction data for every trade. So every import, the buyer, the seller, the type of goods. And this allows us to see what is going into or out of our markets and how we can most target our help. So Kate, if you go to the next slide. Great. So when COVID hit, one of the key effects was global liquidity tightening, and we saw this especially across our markets. Risk went up as everyone sort of grappled with the pandemic and to see what the fallout from it was. The banks tightened up and lending into trade was squeezed. So we looked at where we could most help and how we could target that help. Our objective here was to provide liquidity and to do it quite quickly to meet the urgent need of of the countries that we operate in, to ensure the trade of goods and quite often essential commodities into those markets was not hindered. So how we went about this was by providing special terms to the MRPAs that we already have in place. And we agreed that we would take a greater share of risk on certain priority geographies and also certain COVID sectors. So the priority geographies are CDC's A countries. They're the countries that we feel in most need of support. And the COVID priority sectors for us were very much healthcare. So we financed PPE, but also food security. So where countries were importing quite a lot of their food needs. So what we learned from this process was that working with existing partners allowed us to act very quickly. What also helped is that we worked within existing frameworks and methodologies that we had with these partners. We were able to just tweak them to ensure that the results that we wanted, the targeting was possible, but also to provide that greater level of risk, that greater risk participation, and that greater level of comfort that our partners were looking for at this time. Could you go to the next one, Kate? So that was the action that we did take, and this was the results of that action. This is actually data to 30 December 2020. Sorry, my mistake, rather than 30th September as it shows on the slide. But in the 6 months to end of December, we supported $342 million worth of trade through this program. We consider it a great success. One of the key reasons for that, and you can see it in the chart on the bottom, is our exposure to A countries or priority countries. That grew substantially through the COVID period, meaning that we were managing to channel funds to the areas most in need. We had a good diversity of country exposures. A lot went into Bangladesh, but we also had much wider exposures. Bangladesh was an obvious needer of COVID support, particularly hard hit by the pandemic, but also a very important import-export economy. So lots of trade flows there in any event, requiring support to keep them going. All round, we felt this was quite a successful program. We felt that the special terms in existing programs was something that we might be able to use again in the future and more widely. And we felt our response time was quick as a result of working with these partners in these structures. And I think I'll leave it there, Kate. Thank you.
Great, thanks, Freddie. Okay, so now we're going to head actually back to the microfinance sector, and we've got Mamina Ajazuddin, who is going to talk about how IFC supported this segment during the crisis. Mamina is the IFC's global head of financial inclusion, and she also works as a principal investment officer in IFC's financial institutions group. This involves IFC's microfinance investment and advisory activities globally, with over 6 billion in commitments over 300 MFIs. Mamina's got over 2 decades of investment transaction experience in the financial services, microfinance and manufacturing sectors in over 60 countries. So great to have you with us today, Mamina. Okay, over to you.
Thank you so much, Kate, and to the CDC for inviting me onto this panel. And it's actually wonderful to be with old partners and friends. So just listening to Advance really resonated because we're one of the founding shareholders in Advance and have supported UNCTAD during the crisis, and also shout out to CDC as our co-investor, as well as Symbiotics and Blue Orchard, where we've co-invested in many funds. I think, I mean, you know, obviously from IFC's standpoint, we're one of the largest investors in this space. And so when the crisis began, it was very important for us to play in many different spaces, whether in regulatory conversations on the ground or with the World Bank in terms of the policy or systemic reactions, whether on the ground, you know, seeing what the impact was on various funds and investments, as well as trying to see what some of the trends were globally. So if we could just move on to the next slide. Clearly, we saw that there was a huge impact, I think, notably at a systemic level on poverty. So almost, you know, actually the figures are probably going to go up this year, but roughly 150 million people are expected to go into extreme poverty as a result of the pandemic. It's also led to a big decline in GDP. So if you play this out at a country level, I mean, you know, Advance mentioned their subsidiaries. One of them includes UNCTAD in Cambodia, which, you know, if you look at the left-hand column, in Cambodia, what's happened is a drop in tourism, manufacturing orders were stopped for a lot of the European orders, 500,000 people laid off in the garment sector. So clearly that has an impact, not just on the sector or the country, but also on MFIs and the clients that they're trying to reach. So many of those clients end up being informal workers, and overall, globally, 81% of the labor force has been impacted by COVID. It's disproportionately impacting MSMEs, and we're seeing that play out across the board, you know, with various clients. Initially, there was a liquidity crunch, and it's, you know, turning more into a solvency debate. So what we're seeing is that there will clearly be needs, whether with banks or MFIs, which will require capital strengthening. And emerging market banks are also much more a part of the financial system than they were perhaps in the last 2009 crisis. So, you know, that also has many more implications for what is happening systemically. So moving on to what we ended up doing, the key risks to the sector were clearly, I mean, as outlined, depressed demand, liquidity, solvency is playing out actually. And as moratoriums pass through various markets, you're seeing that this will play out much more in the next couple of years, as well as a digital divide. I think one observation there was that people, you know, we surveyed a lot of our clients, and almost 62% indicated that now investment in digital channels had become an increased or urgent priority. And we're really seeing a huge differentiation within markets of MFIs and banks that were able to be digital, make payments, receive payments, give out loans during this period, during the moratoriums, as opposed to the ones that could not. Funding has been, scarce at the international level, but unlike the previous crisis, as many of the MFIs and banks have now become deposit-taking entity or leaders in their market, deposit growth was actually a happy story during this crisis. There's a lot of happening in the digital transformation space that we were also seeing, play out in different countries, particularly in Africa. And some of our fintech investments have really taken off during this period simply because the use case existed, and that was of course encouraged by various government initiatives. What there is concern about is like reduced new lending. So a lot of the MFI business models have curtailed growth or unable to grow for various reasons, moratorium, client uptake, so the sector growth overall has been fairly much slower than in previous years. So actually, we've had these conversations, including with Maria Theresa and others, in terms of how sluggish is this growth, where will it depend? India, which was a large market, has been affected. Where will the big growth numbers come from in the next few years? So moving on to the next slide, I think our response has been fairly, comprehensive, partly because we are the private sector arm of the World Bank Group. So part of the insights and regular updates that we were doing also fed into what the broader or more senior like World Bank Group response, whether on policy guidance and dialogue at the national level, aligning with other investors, so the impact manager, investment managers, or other DFIs, such as those on this call. We'd also structured a large crisis response facility. So there's an overall like $12 billion World Bank Group package for the financial sector, whether in trade or financial institutions. There was a working capital component, which was launched very early on last year, which basically injected liquidity into like some of the larger systemic institutions. AMRET is one of those. And then we've countered that. We've added to that by having a very structured COVID facility for 400 million, particularly for MSMEs, because we saw that there was a gap in medium-term financing and particularly in local currency. I think obviously the engagements are ongoing with industry stakeholders, and it'll be interesting to see how many of us will have to evolve our responses in terms of potential collaboration. I see a lot more in digital transformation, on supply chain initiatives that were discussed earlier, on agri-value chains, as the needs of the clients have also changed, during this period. So just wrapping up, just to go on to the next slide. Part of, I think, what we're seeing is we've been able to deploy, quite easily to current MFIs and banks to absorb capital, to lend to, MSMEs in part of the recovery. And now that we're moving from a, crisis response to a recovery phase, I think there's an opportunity to build back better. So in terms of what the future will look like, what we're really seeing on the ground in many of our markets is, very active conversations with MFIs and banks, like to go beyond credit, whether to go into agri supply chains, on digitizing merchants. We're seeing a lot of newer players like fintechs and, the payment companies like MasterCard really actively trying to work with MFIs because of the distribution channels. What we've also seen is alternative finance, as new players are mobile and online. So as an example, Fawry in Egypt, which was one of our early fintech investments, has literally become one of the largest companies of digital payments in Egypt, simply because the central bank wanted all of its citizens to have access to finance and digital payments and mobile wallets. So this was an attempt to push consumers in that way, particularly during COVID. I think the third aspect is that market segmentation will be key. So, we're already looking at ways to serve the structurally excluded. So by whom I mean the women, poor, and those in rural areas, particularly in FCS or IDA markets, So it'll be very important to have like tailored blended finance schemes available for them. And we're actively trying to think of, schemes to do that, whether through our gender or climate programs. I think the fourth aspect you're really seeing is like, what will the future look like? Will it be high touch versus high tech? And you're seeing different models play out in this space, which I can happy to address some in the Q&A. I think fundamentally the last lesson for me has been that digitalization has been key throughout the sector, but it's not monolithic. So, we were speaking to a lot of MFIs in this space a few years ago about whether to digitalize and whether digitalization will help improve market share. And COVID has really shown that, though financial sector providers needed to have the ability to both maintain operations while staff were dispersed, but also to serve clients via remote channels, and that was critical. And that there's clear business continuity risks by not being digitalized. So I think one of the lessons we've clearly learned on the advisory side, at least, is that digital is very much part of the journey and will have to be a tool to be able to effectively and efficiently reach the clients that we want to. And so a lot of our, current and future advisory work is really to be able to help existing institutions to not only weather the storm better, but to be able to have those kind of partnerships which will reduce interest rates or payment costs or transactional costs for the clients that they tend to work with. So the end game really has to be that the consumers, particularly the MSMEs that have been affected by COVID, will have access to better, easier and cheaper financial services. I'll just end there. Thank you so much.
Thanks, Romina. I think particularly interesting to hear your perspectives on the digital transformations as well, and we'll definitely dig into that a little bit more in the Q&A at the end. And on that point, if people have got questions, don't hesitate to put them in the chat. No stupid questions, we'll pick them up later in the session. And as Namin mentioned, one of the, I think, concerns that many investors had and other stakeholders was around a kind of potential liquidity crunch in the sector, stemming from the increased perceived risk. And so we've got Yvan Renaud, who is the Chief Operating Officer for Symbiotics. He's going to be talking about Symbiotics' response in terms of handshake agreements and how they worked with a number of other players in the sector in terms of an MOU in this regard. So Yvan is the CEO of Symbiotics. He supervises the investment analysis and origination teams. He joined Symbiotics in 2005, and prior to this, he worked for Blue Orchard Finance as a microfinance consultant in Peru and a small enterprise consultant in Western Africa. So Yvan, over to you.
Hi everybody. So thanks, Kate, for the introduction. Maybe we can go straight forwards to the next slide. So very quickly about Symbiotics, we manage funds dedicated to microfinance and impact finance, and we advise other fund managers willing to invest in microfinance. We've been created in 2004. We have 8 offices. We have all sorts of regulatory arrangements that we need in many jurisdictions. We have originated close to 7.5 billion since the beginning of our existence, and our largest origination was in 2020, last year, true origination. We have worked with 500 investees since inception, accumulated in 19 countries, and we really started with microfinance. Now we have a broader kind of impact range of end client activity, all through private debt to essentially financial institutions. So any distribution is done via financial institutions. We work with 20 or a bit more than 20 partner funds and mandates. So this is for us, we've gone through all sorts of crises. I heard probably talk about Nicaragua at the beginning. So we went really since 2004 through all sorts of crises, whether global, regional, sectorial, or local. But obviously none of these crises were of the extent of what started for us in March 2020, very much with kind of astonishment as a first reaction for us. If you can go to the next slide, please, Kate, thanks. So So we're there in March 2020. We have a lot of boiling plates in the kitchen. We start, of course, with our staff safety, with our people. We start with a huge communication to funds, clients that were really worried at the time. And obviously, we see, and there's always this metaphor that many people use internally and I guess externally also at the beginning of the crisis. We see literally rescheduling requests from investees increasingly coming up. And it's like, I mean, of course, it's not a very nice type of comparison, but it reminds what people said at the beginning of the crisis in terms of the sanitary crisis. You see them popping up 1, 2, 3, 4, 5. Funny said, its advance was kind of hit in all countries at the same time. It's exactly what we have as an experience. It came from everywhere, rescheduling requests. So what came next is that we thought if we treat all these requests as normal workouts, which takes huge time to our recovery teams, we will never be able to treat them all in reasonable time. At that time, Frank Streppel from Triodos conveyed the first MIV managers meeting. And very quickly with Frank, we initiated conversations on how to address and sort the rapidly increasing flow of cases, thinking a bit out of the box from the normal treatment of when an MFI comes for rescheduling. So with a couple of peers, I think we immediately thought we needed huge pragmatism, efficiency, trust in each other in the way we handle these cases. Others were maybe a bit more reluctant to think differently, but it's totally normal, I think. So we said we need to write down what we want to do. We need to put it on paper. And we started working on this MOU that was really about how we treat the number of rescheduling cases we had in a different manner from a normal workout and in an efficient manner, benefiting both the MFIs, their clients, and ourselves and our investors. When we started that, I think early April, I would have never ever thought that we came to a finished MOU by mid-May, I think, and that we could tell everybody that we had an agreement on how we wanted to treat these cases. 9 MIV managers signed off on a press release on that, worth 15 billion AUM, but actually a lot of others, like there was another initiative from other MIV managers on the Pledge group, and there were other ones who didn't sign off, but did participate to the initiative. So everything was very quick and efficient. The objectives we had, first of all, reassuring investors, that was really important. Quick responses to liquidity needs. It's refinancing. They had maturities coming and they were really afraid if the first investors start and say, I need my money back, and then this piles up and they were just unable to repay. Reassuring investors, of course, avoiding uncertainty. I have to be honest, for many MIV managers, avoiding kind of over provisioning or kind of by the book provisioning for workouts, because we hoped and kind of knew we would get funding back even if we postpone payments. Quick response, it's really, I believe quick response is positively correlated to liquidity issues not turning into solvency issues, because institutions can focus on their own issues on the ground and they don't have the kind of vicious circle of lack of liquidity starting. And of course, time management. I can't say it wasn't important for us to just be pragmatic in terms of our time as much as our fellow MIV managers. The approach is really about classifying institutions between first ordinary renewals. We did a lot of ordinary renewals of loans at Symbiotics, which means we didn't even ask other MIV managers what they thought. We said, okay, in this case, we did our stress scenario. We think we can go ahead. And then that second strange category, which is the handshake agreements. This is really about saying informally by email exchanges, quick calls, we say to the other ones, I have a maturity, I want to help this institution, I want to reschedule my payment by 6-9 months. Do we agree to do the same in 1 month's time? And that's really the core of what we did. So that's kind of the middle category, but that's really the one that we wanted to achieve creating by this MOU. And then the usual workouts for cases where, according to different criteria, some common between MIVs, some not common, some individual, we thought weren't able to go through a handshake agreement. The spirit between MIV managers participating to that was really collective intelligence. It's not a bad word. We're not talking about cartel, trust, arrangement, saying we all think the same. It's really about making sure we have ideas. Sometimes we didn't agree on something, but we still advance with our own idea. But mainly it was really about reassuring each other and keeping hold together on what was happening. And then pragmatism, flexibility was of course extremely important, and we were always aiming at the most ordinary outcome. So really starting from the left of the approach line, ordinary renewals as much as possible, handshake agreement as much as possible when we believe it wasn't a completely serene case, and then workouts if it didn't work. If you can turn to the next slide, please, Kate. So after maybe a bit more than a year, our experience at Symbiotics is we had more than 40 real handshake agreements. Again, no formalization of the agreement. It's just we all agree together that we will support an institution with rescheduling of 6, 9, 12 months. Almost all are turning back to current in 2021, which is really amazing because we didn't postpone 2021 payment by 1 year and 2022 payment. It was just really an emergency postponing of payments due in 2020, and we thought we would have to reassess a lot of situation this year. But actually, many institutions, actually 38 or something, a bit even more, turned current. Now this has I think a disadvantage. Mamina showed, I think on what is landing on the ground, it shows that there's been a bit of a shy attitude from the institutions, which is not necessarily very positive, but at least they turned current with investors, and they can then focus, and we encourage them to focus on lending when it's needed, and we believe it's really needed on the ground, still very, very needed. Only 4 of our cases, HSA cases, turned into workouts. For 3 of them, I mean, before COVID, we knew we could have problems. I mean, there were different types of problems. So we did this HSA with kind of limited hopes, hoping something positive would come out of it. For one of them, I would say we didn't anticipate that well the problem, but looking backward, it was kind of obvious. It was school financing institution in India, and since everything stopped in India, including private schools for quite some time, it was kind of obvious that these kind of institutions would struggle. We believe that the liquidity risk, I mean, at this stage today is mostly behind. It was kind of said before also by other interveners, and we do believe that solvency risks remain. So it's not over. We all agree on that, I think, here. The crisis duration will be a huge component of it. In our countries, to different extent, we believe, in European countries, we believe we are kind of seeing at least the light at the end of the tunnel. Vaccination works well. In many countries, in all countries where we work, actually, it's not at all the case. And what it means practically is like some sectors, Mamina mentioned some sector like tourism, and I think tourism has a very large ecosystem. So for small and more small enterprises, a second summer without tourism will be difficult in a large ecosystem. But all in all, we're quite positive, and I think we can show really resilience at this stage of our sector, and amazing resilience for a sector that really focuses on real economy. And with that said, I think I'm at the end of this presentation.
Great, thanks so much. I think that was such a good example of coordination between the different MIVs to give those MFIs the breathing space that they needed and hopefully avoid more of a crisis. Okay, and so now moving to, well, actually fresh liquidity. We've got Blue Orchard, you're going to be talking about the MSME support fund that they launched during the last period. And Maria Teresa Zappa will be talking to that. Maria-Teresa is Chief Impact and Blended Finance Officer and Deputy CEO of Blue Orchard. She's responsible for the private-public partnership funds under Blue Orchard's management and impact practice. So Maria-Teresa joined Blue Orchard in 2008 and previously worked in EBRD's financial institution team at the Asian Development Bank and was an ODI fellow in Africa. Great to have you with us today, Maria-Teresa.
Thanks a lot, Kate, and really happy to, as Momina said, to be really in a close group of colleagues and practitioners. As you said, the idea of really this presentation is to say, what did we do? How do we react to, the impact, negative impact of COVID on MSMEs? 2 words about Blue Orchard, just to start. It's an asset management company and has been around for a long time, 20 years. And you see, some of the proud impact that we have created on the right-hand side. So we've been able to provide access to financial and other services to 250 million people. I've invested in over 90 emerging and frontier countries, and overall I've invested more than $8 billion. If we go to the next slide, there is a quick presentation of how really we do the business. So the business is not done by me in Geneva or a head office in Zurich, but rather in our frontier and emerging market offices. I'm also proud to say that this is really inclusion and diversity. If you look at the numbers on the right-hand side, so 110 staff, but across 35 nationalities, with a 50-50 representation from a gender perspective. If we go to the next slide, here we just one word. It is just to say that impact and really the impact practice it's at the heart of what we do. It's part of our DNA in the company, and something that we have done in 2020, as I guess we were not as busy as usual in dispersing and deploying capital. Something that we have done, we've also started really revamping our impact management and measurement framework. The investment team provided very valuable inputs. We also I guess as a result as well of the partnership with Schroders, we started having lots of inputs on more, if you want, on ESG management. And so we came up with really a new revamped impact management measurement system called B-Impact, which is fully aligned to the operating principle for impact management. And also that it's really following best practice. You have all the logos at the bottom, but really we have been following, the impact management project, SASB for the SDG mapping, and of course, the 20-year experience of our investment team. If we go to the next slide. In this chart, we wanted to really reflect, I guess, on the mission of many of us on the line, right? So, I mean, really looking at the fantastic trajectory in terms of poverty alleviation that has, started. Here you have numbers out of 2015. And what has been really the impact of COVID? Here we are, assuming two different patterns. One is the COVID-19 baseline projection, and the red one, which is probably, the most, the worst case scenario, it's really the COVID-19 downside protection. So as you can see, that the impact of COVID has been really on, certainly stopping the progress done in terms of poverty alleviation, stopping this trend, and potentially, achieving as much as 150 million people in the poverty trap. And I think something that actually we had discussed even with Momina is that the poverty has impacted not only, the least developed countries, but also some middle income countries. So again, really the new poor have been, growing as a result of the pandemic. If we look at the next slide, really here I wanted to report some data. I mean, some of it has already been illustrated by other colleagues on the line. These are the results of two surveys. One is a survey that was run between January and May 2020. So very much at the beginning of the pandemic by Facebook, OECD, and the World Bank. And here you can see that, the impact on small businesses already at that time was pretty significant, with 26% of these small businesses surveyed, suffering, really being closed in a way. You see here some of the reasons. I think, the sectors most impacted, as other colleagues have already said, the travel and tourism, hospitality, education. As you know, we manage actually an education finance mandate. So we were really, very alerted to the fact that schools were closed, and a lot of financial institutions suffer from really not having this new line of business, in a way, having this very much impacted. And also, of course, all the, the hospitality sector. Another, on the right-hand side, you have the results of a survey that was run more recently by the Center for Financial Inclusion in February 2021 on approximately 3,000 micro, small, and medium enterprises in specific countries: Colombia, India, Indonesia, and Nigeria. Again, here you see the impacts that were not only of really, business that suffered, closures, but also how their profits decrease, how many were, as many as 43% of these micro, small, and medium SMEs were not even able to really cover their operating expenses. And of course, the impact on jobs lost and really bottom line, owners of businesses reporting that they had really difficulties to make ends meet. If we look at the next slide, we can see, at the beginning, I think in February, March, we realized that in addition to the great initiative that Ivan already covered of this, let's say, movement and general understanding and collaboration between microfinance investment vehicles in terms of looking at, really rescheduling current obligation of investees. But we also realized that there was really need of additional liquidity. And so if we go to the next slide, we started really in, I think in March, discussing with a number of group of investors that had been investing in blended finance vehicles, established by Blue Orchard, and really we tried to find how could like-minded investors have effectively a reply to to the existing liquidity crisis. So this is really, I think, for me was something incredible, because we know sometimes development finance institutions don't move fast. I think even the colleague of CDC said in the beginning that the pandemic, if anything, really made us all convinced that we had to have a prompt reply to the crisis. So this resulted in this blended finance impact partnership, where CDC, USDFC, KfW, JICA, FSDA, they all effectively managed to deploy capital very fast in order to be able to provide liquidity to micro, small, and medium enterprises. As you can see, the impact is to effectively maintain 200 million jobs. We broke this down per $100 million invested into millions of entrepreneurs, jobs maintained. But really what I would like to say, Kate, here is that what was incredible is that there was the risk appetite as well to provide new liquidity in a situation where really micro, small and medium enterprises, in addition to having their current obligation reschedules, were really seeking additional capital and additional finance. Thank you very much.
Great, thank you, Maria Teresa. Actually, thanks to all our panelists as well. I think it's been really interesting so far in terms of the overviews. And also thank you for keeping to time. It's very punctual. I was sure we were going to run over. So we've got quite a bit of time now actually for Q&A, which is great. And so I'll jump in with a couple first, and do continue to put some in the chat. We've had some really interesting ones come through so far, so hopefully we can answer most of those. So as mentioned by both Momina and by Maria Teresa just now, we have observed that SMEs are probably most disproportionately impacted during the crisis, stemming from this kind of reduced access to finance, but also the business disruption as well. And Freddie, you talked about the kind of broader systemic liquidity response, but I think it'd be interesting to hear, how did the MRPAs help SMEs particularly?
Sure, thanks, Kate. So our MRPAs, they tend to finance more corporate or mid-sized company flows. We do get some SME financing through them, but the partners we work with and the banks that they finance, their clients tend to be the larger clients in our markets. But we acknowledge this, and as part of our COVID response, we actually also began a separate program which we are seeking to launch quite soon, which is targeted specifically at SMEs. And our strategy there is to work much more with MBFIs, trade finance funds, specialist originators in this space, who are often very local, on the ground presence, doing small tickets in a variety of sort of financing structures. So the MRPA process works, but we think deployment through intermediaries rather than big banks, through MBFIs and funds, will probably be a better approach for targeting and getting down into SMEs.
Okay, that makes sense. Thanks, Freddie. I think another thing that really struck me during the presentations as well was just noting the importance of coordination between different investors to really make these responses most effective. So Evan, you mentioned obviously the MIVs that came together for that MOU, and it'd be interesting actually to hear, outside the MIVs, how do you coordinate with kind of DFIs and local banks, or obviously lenders to the MFI space as well. And then also Maria Teresa, I think you mentioned quite a few of the investors at the end and the blending of capital, but I'm also aware, different DFIs and impact investors have different mandates, slightly different ways of approaching funds. I mean, how did you facilitate and manage their different approaches into your capital structure?
Yeah, I'm happy that you asked me this question, because if you had asked me this probably in February last year, before we actually managed to do it, I would have been a bit less optimist. But in fact, we did. We managed, and I think there was. I think all of us had to really adapt our investment processes. I mean, this is for the investees. I think the case of the Advance, how they managed the crisis, it's exemplary, but it was the same for, impact investors like us. It was the same for development finance institutions. So the way that we actually managed to really get everybody on board is that we had to be market relevant, and to be market relevant, we had to effectively coordinate jointly our initiatives. So for example, we had due diligence with as many as 7 investors at the same time. And I think that what was really incredible for me was that all the investors realized that in order to be, rapid in the response, they had somehow to put on aside their own specific criteria, and that we should, all move forward with, let's say the same objectives at hand. And this was from a fund manager perspective, certainly very, very welcome. The other topic was really, as it is often in blended finance, how could certain investors take more risk and really provide in these critical times, risk mitigation measures to attract other investors that might have, different objectives, as you say, different mandates. And the third one was the geographical aspect. What we did in this COVID-19 initiative, we created two sub-funds under an umbrella fund, so that investors that were really, for example, JICA that is concerned and was concerned and could only invest in Asia would invest in Asia. Investors like CDC were, had effectively a CDC target country sub-fund. So we tried as much as possible to make sure that all the investors could, in a way, work together. And whenever there were bottlenecks, we tried to address them. But I think it was an incredible exercise. And I wish every DFI and blended finance fund could be as fast.
We've set ourselves a precedent now. This is the issue. And Ivan, do you want to talk a bit about the approach you had with some of the other lenders outside the MIV space?
Yeah, I think one interesting thing, if we compare the MIV space with DFIs, is that it's more difficult. I'm not talking about lack of activity, slow or whatever, Alex, to compare with what you said at the beginning, but it's probably more difficult, interestingly, for DFIs to twist, adjust processes and things on the existing. Which is, they had loans with institutions where we wanted to reschedule, and there are procedures that are very clear at DFI levels. Maybe difficult to adapt in a rush like that, which is totally understandable. We may be more flexible because we are smaller, which doesn't mean that we did things in total informality, of course. The funds and the investors didn't understand what we did, but so on that front, it was more difficult. From a spirit standpoint, the DFIs were really helpful, but it was more, of course, difficult to join that kind of very light formality approach. But at the same time, they do new things, and they focus on new things, new funding, new TA as IFC, as CDC. So it's interesting to see a different approach here. On our side, we did create a lot of new loans. At Semiotics, as I said, it was our record year of origination, but we really were we were in our ecosystem, in our value chain, keeping everybody together and really kind of strengthening that value chain. Creating new things last year wouldn't have been that much possible for us. Brocha did it with the DFIs. We really focused on the private sectors ourselves. And then the local lenders, we have examples of free riding. I have to say that with local lenders from time to time in single workouts. In this case, we didn't have any because I think it's such a systemic crisis. Everybody mimicked what the other countries were doing. Regulators played a very interesting and strong role everywhere. So the whole sector kind of played the game. So we were never close to local lenders in knowing if they would renew loans or whatsoever, but we would know in 95% of the time that they would do so just naturally because of the regulators. Sorry for the long response.
That's great, thank you. And so, Advan's mentioned at the start that digitalization was a key benefit to be able to continue operations during the crisis, and Mamuna also mentioned it. That we see kind of explosive growth in this regard in the sector. Although I do agree with her comment that kind of high touch as well as high tech models will be needed for the segment. So maybe Alex, Mamuna or Fanny, can you talk a little bit more about your experiences of this, maybe some other examples of investment or technical assistance made into digital channels and services?
Sorry, my mic was off. I can start, and I'm sure Alex and Momina will have much more to say, but I would just say that during the crisis and even now, we could see a peak in the usage of digital channels at Advance, and if I just take the 5 countries of operations where we have the biggest variety of channel and digital channels available, the number of transactions before crisis and after crisis was up from 17% to 39%. 9%. So it means that our clients who basically transacted less during the crisis because their business were closed or they had limited activities, still when they had to transact, they used digital channels available much more. So that was, and one of the key learning is that once the behavioral change is triggered, and it was triggered by the crisis at that point, the behaviors actually stayed that way after the crisis, or when the activity was a little bit back to normal, branches were open again, etc. So we can see still now a higher level of transaction coming out, being transacted outside of branches and specifically through digital channel. We have a digital investment plan, and we are accelerating on that in all our countries of operation right now. I would also say that during the crisis management, the fact that we could rely on strong digital systems internally and digitalization of processes has helped us a lot in terms of standardization of the solutions we were putting in place for our clients. So it's a lot. It has a lot to do with the way we can continue, and it's critical to continue onboarding clients on digital channels. That's on the client side, but internally and in terms of process and system, information system, it also needs to continue changing in the right direction and investing in digital, because this is how we can remain and become even more efficient in the way we answer our client needs. I would just add something on a slightly different way of behaving between women and men. We could see that women actually used more or changed more their behaviors toward digital channels. Their usage was lower before the crisis, and they are the ones who actually started to use a little bit more than men the digital channels, which is also something that we are looking into right now. So how can we make sure that we adapt the onboarding process and the digital education, so that our women clients and borrowers are also well helped and supported when it comes to starting using digital financial services.
Okay, perhaps I can go next. I've just circulated a study which had come out where we had looked at some of our clients in Africa, and so disproportionately there was an impact, like a larger impact on women. But what was really interesting was that the women-led MSMEs were using digital much more than men. And part of it was because they were, marooned at home and, had to rely on some of these services. So it's interesting to see some of these digitalization trends play out in different markets. I think, in terms of the financial sector providers, there are two ways that they're looking at digitization. One is to remain competitive, and the second is to improve the resilience of, what the work that they're doing. So what was very clear during the pandemic was that MFIs realized that they had to maintain operations with staff who were dispersed, but they also had to serve clients through remote channels. And some of the early lessons that we also had from China showed that actually some of this switch to digital lending, that for every 1% increase in digital lending, you actually have a positive impact on the real economy by almost 2.5%. So the differential is quite huge. And if one is to look at it, across channels, products, and processes, there have been several moves by policymakers, whether in Pakistan or Kenya, Uganda, to ensure that there is a use of digital payment instruments, easing, to make it easier to open accounts, particularly for women. Sending remittances, removing fees for sending and receiving funding, ensuring that there's liquidity at ATMs and agents, and particularly on the agents. So I think we're at this technology tipping point for the sector, where it'll be really important for people to realize that the business will be digitally enabled in the future, and many people are now used to doing that, even at the base of the pyramid, particularly even in markets and things like that. So part of the learning will have to be, how do you digitalize your operations better so that you're able to manage risk, but also to reach new clients in a more streamlined manner. And I mean, it's interesting how we're seeing this play out in different regions. When I'm looking at some of the chat which is coming through, I mean, in LAC, we've had clients who've been able to move on to digital or launch online digital products. So, in Peru, we've seen that they can do like a 100% digital lending product for smaller micro clients, which they wouldn't have been able to do in the past. What you've seen also in Nigeria is like a lot of the MFIs were really affected during the moratorium itself, but have switched to the volume of like their agent networks have almost doubled in terms of the payments. So what they weren't able to do on the lending side, they made up from payment flows and agent network flows. So I think part of this will be that digital transformation has to be part of the corporate priority for many of the MFIs and banks as you come out of this pandemic, because if you don't, you actually end up losing market share. And this is a very live conversation I was having actually this week with a board member in Nigeria who was saying that, we didn't realize how much at a disadvantage we were in terms of we've lost market share because we weren't digitally capable enough. And this is now boards are even like waking up to this, in many markets. Sorry, just one last thing is like on digital transformation. I think what's also been very clear for us on our advisory side is that if you're not able to address risk management in the basic level, then even when you go digital, there has to be a much stronger onus on risk and managing risk, right? Because you're exposing your consumers to clients to a completely different level of risk, whether it's transparency, cyber protection, all of that. And that also, we're realizing has to be part and parcel of the package. Thanks.
Thanks, Maria. So I'm just looking at the questions that have come in. It's quite an interesting one here. So someone's mentioned that, Tom Keller has mentioned that Amina shared an expectation of 10 to 50 billion of capital strengthening, and Ivan also shared solvency risk remains, but it's been limited today. So can any of the panelists comment or elaborate on what you're seeing on the equity side of the balance sheet? Any distressed investees or any challenges raising equity capital? And maybe I can actually just comment briefly from CDC side. So obviously we are seeing reduced profits and increased provisioning levels, which are having some stress on solvency and erosion of capital. And to date, we haven't had any kind of distressed assets per se in our portfolio on the FI side, but obviously we are seeing further waves, places like India, Philippines, Myanmar for other reasons as well. But, it will lead, I think, to certainly the smaller assets having solvency issues in the future. I think that is a reality. And maybe this will lead to some more consolidation of the sector. On the equity raising, that is going to be challenging. I think first just because of risk appetite from more mainstream investors, but also, there are challenges around travel at the moment, being able to do due diligence on the ground, which is maybe slightly easier if you're looking at a debt investment, but for equity, you really need to be there to kind of look people in the eyes sometimes in order to do your investment. So for co-investments or working with our GPs has been a way forward. Or utilizing kind of resources on the ground. But maybe Amina, you can add to this as well.
Yeah, thank you. So it's interesting when you play it out at a country level. So I mean, I was just thinking of Lebanon's been mentioned a couple of times, and there the country is obviously going through extreme political, social, economic turmoil, and that's played out in the microfinance sector. And what you see that play out very differently for globally for banks versus MFIs versus co-ops versus. So it really depends whether you're deposit taking, have multiple companies in different markets. So just to end on Lebanon, like if your clients, Al Majmoua, which is one of the largest MFIs there, just reported that 40% of their clients now need grants rather than loans. Obviously, that changes the business fundamentals for an institution serving that base. In Kazakhstan, you're seeing, just the regulatory policies forced an MFI to change its provisioning, and they had to restructure 40% of their loan book. in other countries like in Nigeria coming out of moratorium, or India, like, you know, there's still an uncertain impact on balance sheets. So I think part of this really depends on, you know, how this is playing out at a country, sector, as well as an institutional level. I don't think it's across the board. I think one thing is pretty clear, that even if you were diversified across countries, which some of the holding companies are, it really depends on, you know, which countries you're exposed to. And you know, some of these market impacts are much larger in certain markets, particularly because of other issues like economic, social, political issues, which are now affecting MFIs more. Just to add, I just wanted to answer the question quickly while I have the floor on climate. Again, we're seeing, I think this is more a longer term issue. I mean, Maria Teresa and I worked on MIFA, this fund where we even tried to do climate financing, and there wasn't that much appetite amongst MFIs unless they were given, you know, like sweeteners and incentives to do so. But I think we're looking now very actively at institutions or climate, you know, particularly through our upstream work, which is like building the environment in certain markets like Ethiopia or Uzbekistan, etc., to see how you can leverage some of the solar panel or solar financing work, and make sure that some of the digitization of agri supply chains also has a climate component, and that it's being done in a green way. And that's a huge space in itself. And I think it impacts a lot of what one can see in the real sector, as well as, you know, MFIs, which are going more into like agri and MSMEs. Thanks.
Great. Maria Teresa, do you want to comment as well?
Yes, absolutely. So on the solvency, it's really, I think, a good question, in the sense that, for example, when we started this COVID-19 impact strategy, we really had initially designed the strategy with a private equity component. And the idea was that already in March last year, we could perceive that there was a part of, you know, a liquidity weakness of the investees that could turn into a solvency issue. Now, for a number of reasons, the equity component was not pursued. I think investors felt that at that point in time, the liquidity was the main topic. But I have to say, it has been really interesting that in a number of CGAP, you know, surveys, the Pulse survey is that really have shown how, with you know, more recent data, big difference between the March and then the September data of 2020, where really the issues were much more crystallizing into solvency issue. And as Momina said, exactly because there was if you want, the impact of the moratoria, in particularly in some countries. So as a result of that, on our side, we are building up a financial inclusion strategy with the idea really to tackle this. Also, I wanted to make a quick comment on the 2x challenge. I think that I saw a question in the box on this. On our side, it's certainly something that we are now applying to all our investment funds. I think these resonate to the investees, resonate with us and with investors. So for example, even in this case, we were able to qualify for the 2x challenge. So if anything, I would say that the gender perspective in the COVID-19 environment was very prominent, and it was very prominent everywhere, also to the importance of you know, female roles in the health sector. If anything, I think it did help to put really the gender topic in the spotlight. Thank you.
Great. I think unfortunately we're about to run out of time, but thank you everyone for attending, and thanks again for our wonderful panel for your insights. I think this has really demonstrated the need for certain investors to weigh appropriate risk against impact to support the sector during a crisis. It's been interesting also to hear about kind of different innovative structures to meet market demands, the importance of both financial and non-financial responses, and the value of collaboration between investors to make these truly effective. So As mentioned at the start of the recording of the webinar, this will be put up onto the FIF YouTube channel, so please take a look there, or on the FIF website as well. And also on the FIF website, you'll be able to find out more about the network and how to get involved, whether that's to share information or support us on an individual or corporate basis. So all the links are up there, as well as our PayPal QR code. So thank you all again for attending. Thanks to our sponsors, and I hope you all have a lovely day.
Thanks, Kate. Bye-bye.
Thank you. Bye-bye.
Bye.
Thanks, bye-bye.
Thank you. Bye-bye.